That right there is the number that gave a lot of people, especially on the retail side, a reason to buy there. Oh, that's not nearly as bad as we thought. And everything is, dead right now. It's only up from here. Great. No. Let's break these numbers down a little further.
Bear gang till I die, ho. Swooped up the homies and we about to start a sideshow.
Okay, earnings are exactly what they imply. They are going to quarterly, Q1, Q2, Q3, Q4, which means every 3 months, they are going to release a report that tells you in the last 3 months, the quarter previous to that, how much money did they make, how much revenue, how much profit, how much debt, their EBITDA. So they're going to give you a breakdown of how they performed, right? Now, going into earnings, experts will give an expectation, right? So they might say, we're expecting 400 million in revenue, 20 million in profit, debt to be at 40 million and EBITDA, whatever. Now, when those numbers come out, either they beat the expectations or they missed the expectations, right? So we expected 400 million, they had 550 million. Fuck yeah, they're making more money than we thought. And if this continues, we're going up. Or if revenue comes in at 300 million, shit, they missed the expectations. So they're doing something that's below expectations, which is not good. You're investing in the long-term growth of a company, right? Same thing with profit, because the difference between profit and revenue is how much money you made and how much money after your expenses did you actually keep, right? So that's what earnings are. Now, there's a second part of that, and that's forecast and guidance, right? So if they miss on revenue, but say we missed, but we have this new contract, or we have this new coronavirus thing, and we're expecting to have 500 million next time, forecast can make this not be as bad. Or it might be the opposite. They might beat on revenue and say, we made 500 million in revenue, but we expect our sales to slow down because China trade war. So then even though they did really well, people are like, fuck it, I'm bailing because they ain't making as much. And then the dust settles, right? So that's what an earnings is. It's basically them. It's like if you had to, you went to your work and they give you a performance report, right? But this is them giving their own, okay? That's what earnings are. So a couple things to understand, guys, with earnings reports. Why would an earnings report come out bad and people buy, or come out good and people sell? So there's a lot that goes on behind the scenes. And a lot of it is there's so many details, right? So you have to think to yourself, what you have to think to yourself is, as an investor, if I've been in this stock since this price, is what the information that comes out during this report and this call, does it tell me it's still going to continue up on that same trajectory where I can continue to make money? Or has it do I think that we're kind of at a level and I'm going to walk with my profits, right? So that's kind of where you look at it. You say, all right, I've been in Disney since 120. It's 147. The report comes out and says this. Do I think I can still make good money at this point, or do I want to walk with the money? Okay, that's what happens here. This is what we're going to do. We are going to look at the report here, and we're going to break it down and show what is what, okay? Where these things are. All right, so Walt Disney Company today reported earnings for its fourth quarter and fiscal ended year October 3rd, 2020. So remember, guys, when they show their report, it is not for the current day. It is for the previous quarter. Diluted shares per earning from continuing operations for the fourth quarter was a loss of 39 cents per share compared to income of 43 in the prior year quarter. All right. So what does that mean? That means that they lost money. Disney doesn't usually lose money. Okay. Diluted EPS, so earnings per share for the quarter, was a loss of 20 cents compared to the income of $1.07 per share. Okay, so $1.07 per share increase in the value versus a 20-cent loss. That's huge, guys. Okay, that's huge. Now, EPS from the earnings per share from continuing operations for the year was a loss of 1.57 compared to income of 6.26 for the prior year. That means their continuing operations day to day moving forward is ungodly bad. add a cup. Pretend this is billions instead of dollars. Okay? Pretend this is billions instead of dollars. So instead of a $6.26 billion income at this time last year, they lost $1.57 billion. That's a $7 billion difference on the loss side. Okay? Excluding certain items affecting comparability, EPS for the year decreased to $2.02 from $5.76 in the prior year. Okay, so now that we've gone over that, let's look at why some of this happened, okay? All right, revenues. September 28th, which was the end of the same quarter last year, versus October 3rd of 2020, okay? So they went from 19,118 to 14.707. Huge loss. Absolute huge loss. Okay? That is a 23% loss in revenue. Year ended for their fiscal year, not just for the quarter, 69,606 to 65,388. Only 6% loss in revenue. That right there is the number that gave a lot of people, especially on the retail side, a reason to buy there. Oh, that's not nearly as bad as we thought, and everything is dead right now. It's only up from here. Great. No, let's break these numbers down a little further. The loss from continuing operations before income taxes. Last year, 1247. This year, negative 580. And just so it seems like bigger numbers, so it kind of gives you guys a big understanding, let's call it billions, right? Let's call it 1.247 billion versus 580 million loss. Okay? As far as year end, we'll call it 13.9 billion versus 1.74 billion in losses. All right? That's huge. That's absolutely insane. Even if this was just money in your bank account, imagine last year you made $130,000 or $140,000 for the year, and this year you lost $17,000. Not from your $140,000. That was your income for the year. Last year you made $140,000 for the year. This year you lost $17,000 for the year. Insane losses, okay? And that's their operating income, okay? Total segment operating income went from we'll call it, like I said, billions. We'll call it for $3,425 million to $606 million. Huge loss. 82% loss quarter over quarter, okay? Year over year on the quarter, and then a 45% loss on year over year. Their net income, the loss from continuing operation, this is net. This is with taxes. $777 million to negative $710 million. For year over year, $10 billion to negative $2 billion. That's a $12 billion swing. That's insane. They literally just broke down the numerical value as we're not putting it there. Okay? The diluted EPS from continuing operations, guys, 43 cents per share to negative 39 cents per share. Okay? Year over year, fiscal year over fiscal year, $6.26 cents per share. Is this meat good? Smells good. Did you just bring a handful of lunch meat to put in my face to ask me if it was good? That's my wife. All right. The diluted, absolutely astronomically bad. Okay, so cash provided by continuing operations. Okay, this is another reason that gave people hope for the future. Okay, quarter over quarter, year over year, 17. Let's call it billions, just like I said, so people can understand what we're talking about number wise. 1.7 billion last year to 1.6 billion this year. Only a loss of 3%. However, the cash provided by continuing operations, 5.9, almost 6 billion for last year versus 7.6 billion for this year, which is 27, showing they have more cash on hand. Okay, more cash on hand. Free cash flow, okay, went from 409 million to 938 million, over 100% increase. And free cash flow for year over year, fiscal year over year, 1 billion to 3.5 billion on hand. Okay, so why would people buy it?
Gang till I die.
If we know, thank you, Yesu, appreciate you, man. If we know that they're having all these problems, why are people buying at $140? Because wait a second, their revenue is actually not that bad year over year. Free cash flow is increasing, and we're at considered what the worst of COVID is, right? So the only thing that we could think of is, well, fuck, if 140 is where the market has decided the value is, and they're actually turning the corner and it's only up from here, we're gonna do it. It's Disney. Disney owns the world. Okay? Let's talk about where the losses were. Okay? We're going to look at a little things. This is just their EBITDA, guys. Extremely bad. Total segment operating income, 3.4 billion year over year quarterly, down to 606 million. And then year ending, 14.8 billion to 8 billion. Huge losses. Okay? Now, if we look at here, right here, where their revenue came from. Okay? This is what we're going to look at here. Media networks. Okay? They're media. They actually made money on media. Well, that makes sense, doesn't it? People are stuck at home. People are stuck at home. People are watching more shit. So when you look at their media networks, 6.5 billion and quarter over quarter, 7.2 billion from quarter yearly. And from year over year, media networks went 24 to 28, which is surprising because they had to scrap so many of their movies. But Disney Plus and restreams and purchasing of streams before of their intellectual property for other platforms before Disney Plus launched actually helped that. Okay? Now here we go. Here's where we start getting into the sick shit. Wait, not like bad stuff. Parks, experience, and products. People don't realize 25% of their revenue comes from their parks. You don't understand how much of a cash cow those are. You do not understand how much of a cash cow that has been for them. Okay? Last year, same quarter, $6.6 billion in parks in one quarter. $2.5 billion this quarter, which doesn't even make any sense. Year over year, $26 billion down to $16 billion. That's a $10 billion loss. Okay? Studio entertainment, 52% loss, 13% loss. Now, here is where we get our actual somewhat money. Direct to consumer and international. It's your Disney Plus, guys. 3.4 billion to 4.8 billion. Increase quarter over quarter. 9.3 billion to 17 billion year over year. Okay? All right, here you go. Here's the meat and potatoes of it. All right, the following table presents the number of paid subscribers in millions for Disney Plus, ESPN Plus, and Hulu. Disney Plus, 73.7 million subscribers. ESPN Plus has increased from 3.5 million to 10.3 million. Hulu, 25.6 to 32.5 million. And for their live TV, 2.9 to 4.1 million. You guys, this is literally why they popped overnight. Okay? But when we break it down a little bit further, you'll see why I wanted to short it open. That income taxes, here you go. Their tax rate. Here's the fun fact. You guys want to know how to get away with taxes? They paid a rate of 27.3% in income tax last year. They paid negative 8.4% this year. They took such losses, they actually made money from taxes. They wrote off that much. Okay? Cash flow provided by operations. Okay? This is free cash flow. They've also got rid of a lot of people. 5.9 billion to 7.6 billion quarter over quarter from year over year. $1.6 billion increase. Investments in parks, resorts, and other properties. Okay? They went from 4.8 billion to 4 billion. Okay, it's actually a $854 million difference. And their free cash flow actually increased significantly. Okay? And that's a lot of to do with they're not putting as much money in right now, and so they have more cash on. However, it's not good when you're sitting on a lot of cash when a company like this, and the reason is you want that cash to be working for you. But the most important numbers as far as like from a retail trader side are what we saw at the top, okay? And then this is the condensed, consolidated one, all right? I'm almost done. I know some of you guys right now are getting completely bored to shit. But let me just put it this way, okay? This is the one you want to look at, okay? This is the condensed income statement, all right? Basically, revenue year over year decreased by $5 billion. Year over year as far as fiscal year, 69 to 65. All the rest of it breaks down here. These are where the numbers are. You're going to want to look at current assets as well. Okay, their assets for cash has gone insane. Their cash on hand went from $5.4 billion to $18 billion. All right, receivables actually dropped, but they're making money. They've got cash on hand from also selling assets and putting people out of a job, unfortunately. Liabilities are on par here. Basically, what I'm going to get at, because I'm not going to spend 20 pages of this, what I'm getting at, all right, what I'm getting at, guys, is that there isn't a justification for this to jump. However, it wasn't bad enough to make people liquidate their position, right? Most people that were already in this look at that earnings and say, it ain't good, but it ain't the worst. And I think we got a lot of uphill from here, so I'm going to hang on to my share. However, when we saw that spike overnight, the reason I wanted to take a short short on it was because I knew that the people who were in who didn't want to wait around were going to sell at that high level because it wasn't justified at that point. It's justified staying at the level that if nobody's selling it, because obviously not great, not bad, but I've been in it since 100 or 120. I'm holding because I know Disney's going to come back. Maybe it dips, I buy more. But for people that are looking for profit, that spike this morning was the perfect out because the price this morning at whatever it was, what was it, 140, 141? There was no justification for that price. Easy to walk away with those profits.